Hi, this is Hutch with bankingtruths.com. Today we're going to talk about borrowing, specifically borrowing against a life insurance policy that you designed to be your own private family bank. And what you see here on the screen are the different parties involved. Up in the top left would be a traditional bank. Over on the right would be an insurance company. Down on the right would be your insurance policy designed for banking. And obviously on the left is your family for whom you're funding the bank for. So the biggest advantage to borrowing against a policy is the fact that however much you borrow, your full equity is in there compounding for you regardless of how much you borrow. And people often mistake this as, aren't I borrowing my own money? And when I pay interest, aren't I paying interest back to myself? And although it may feel like that, and the impact of the policy almost makes it seem like that's what's happening, but technically you're not. What's actually happening is the insurance company is happy to give you a loan at any time for any reason. In fact, they're going to put it in the contract language of the policy that they're guaranteed to provide you liquidity up to the some function of your cash value. Usually it's somewhere between 80 to 90 something percent. And they're happy to do this because essentially they're just holding your policy as collateral. They're the one that has your cash value. So if you default, you don't need to worry about paying them back. You just lose your policy and your policy equity. So going back to the collateral, even though they're holding this value as collateral, and if you look at your statement, the net surrender value, or NSV, will be lower. So if you had $100,000 of cash value, and let's just say you borrowed 80, it might show up like you only have 20,000 of net surrender value. But actually the full balance would still compound for you, including the amount you borrowed. And that's because it never left the policy. Again, the life insurance company is just earmarking it as collateral while you make the loan. So they're going to provide you with the liquidity, and for that liquidity, you're responsible. You at least owe them interest. You don't necessarily have to pay interest on a schedule like you would with a traditional loan, but we're going to talk about that in just a little bit. So once you get the liquidity, it's going to come in the form of a check. So when you have this, even though other people discussing banking are saying, hey, get away from the banks, get away, well, you still have to deposit this somewhere to actually get the money to go use for whatever you want to use it for, be it vehicles or investing in real estate or investing in your business or some kind of family expense, whatever that is. So the thought of completely cutting banks out of the picture may be a little asinine, and really you should use banks for what they're good for, and that's convenience and the technology, the fact that they have branches, online transfers and bill pay and whatnot. Banks are totally fine to use them for the convenience of moving your money. But as far as parking your reserves, we suggest when you're talking about big dollars to use a policy, since not only are you going to most likely get more growth, but there's additional benefits too, whether it be a death benefit or other kinds of chronic illness, critical illness, critical injury benefits, terminal illness. There's other benefits you can get from the policy, not to mention whatever growth you do get would be sheltered from taxes so long as you keep some sort of this, some amount of this policy in force. So again, although it may seem like you're paying yourself interest, you're not. You're paying the insurance company interest for the use of their funds, but they're not taking away any of your funds from growing inside their coffers at oftentimes more generous rates than you'd find in an actual bank. So a common question I get is, a 401k loan kind of like borrowing against your life insurance policy? And you already learned that one of the key differences with life insurance is you're borrowing against an asset that continues to compound for you. With the 401k loan, it's actually just the opposite. So you're actually borrowing from your 401k. So let's just say you took a loan out from your 401k. all of this, the rest of your account would continue to stay in the funds that you had and hopefully grow for you, but they're actually going to redeem the funds. They're actually going to extract the money from your funds, give it to you, and that's why I say it's a single-use dollar. So the money that you pull from a 401k are working for you, whatever you're doing with those funds. With life insurance, it could be working for you in multiple different ways. Well, it's working for you inside the policy, even though you have a lien against some of your cash value. It's also being used for whatever you're investing in, be it real estate or whatever. But also there are these additional benefits. So there is, as we discussed, usually a substantial death benefit over and above your cash value, which can go to provide liquidity to your family if you were to pass away prematurely. Even if you have a loan outstanding, the insurance company would just lop off the amount of the loan from the death benefit they ultimately pay out. But also some of these policies now have chronic illness benefits, critical injury benefits, terminal illness, so that they are propping up additional benefits. And that's why I say not only is it dual purpose money, but it's multiple use money. It's like you have $1 wearing multiple hats for you with a policy. It's a nice blue hat. So going back to some of these other parameters, the loan to value percentage, which is what I have listed first here, is a very big differentiator. So with the 401k loan, the maximum you can borrow is 50% of your account value, and that's only up to $50,000. So when you get up to greater than a $100,000 account, you can still only borrow the 50. So as your account value grows, this percentage will become less and less and less. With a life insurance policy, it really depends on a lot of factors, but we find oftentimes it'll be somewhere between 70 to call it 90% of your account value. Sometimes it'll be a little bit more, sometimes it'll be a little bit less. And again, this depends on how much you're funding over and above the basic premium, whether or not you have any kind of higherly cash value riders on the policy, whether or not there's any surrender charges, but it's usually substantially higher than what you can borrow from a 401k. Both of these are a private loan from the standpoint of it not being on anybody's credit checks or any radars, the fact that you have a 401k loan. However, I was reflecting when I put this on here that to some degree, a 401k loan is like a public loan in that you owe tax, right? You owe tax on some of this balance. So essentially you're borrowing from public funds, which is probably why the parameters and loan terms you're going to see below aren't nearly as favorable. And there are no additional benefits that I know of from borrowing from a 401k. So if we continue moving on here, the payment structure of a 401k is quite rigid. So you usually have to pay it off within 5 years or sooner. And it may be sooner if you leave your job. So if you left your place of employment, you have about 60 days, I believe, 90 days maybe to pay off this 401k loan. And if you don't, it's deemed a distribution. So it's deemed a premature distribution. And so the consequences would be you owe taxes on that money and penalties, the 10% premature withdrawal penalty if you're under age 59 and a half. A life insurance loan, conversely, there's very flexible payment terms, as we're going to see below, and the consequences for default are really that you just lose your policy. And I know that that seems quite dire, but what's ironic about this is when I ask people, when I talk to people about using life insurance to build their own bank, they often tell me that they don't really care about the death benefit. They're not doing it for the death benefit. They just want maximum performance. It's all about the cash. But yet somehow when I say, hey, you're losing your life insurance policy, the thing they didn't care about, they're like, wait, I don't want to lose that. Which I find a little bit amusing. But, you know, if we just compare, and you've probably seen other videos where I talk about, you know, paying cash is almost like a dead asset. So you're saving up cash and spending cash and saving up cash and spending cash. When we compare that, if we just overlap that with saving in life insurance, letting it compound, and then doing the same cash flows and borrowing against the policy to hopefully end up at a higher place in line each and every time, you know, even if you cashed out the policy very early on, wouldn't you be at roughly the same position if you just paid cash? And if you continued doing this for a number of years, you'd probably be better off than if you just paid cash the whole time. But at any rate, let's go on to the duration. We did discuss for a 401k loan, it's a maximum of 5 years. For a life insurance loan, I'm just going to put lifetime, meaning the insured's lifetime, because technically a lot of people don't realize this. Technically, the loan is not against the cash value. So when you borrow against your life insurance policy, although the insurance company is holding your cash value as collateral, the loan is technically against the death benefit. And that actually provides us some of the most flexible terms that we're going to talk about here. So when we look at your repayment options with the 401k loan, you have one option. You have to pay very structured principal and interest payments. With a life insurance loan, you could and you should pay P&I, because what that's going to create for you is a situation where you're paying simple interest on a decreasing balance while earning compound interest on an increasing balance in a tax sheltered environment, no less. You want to at least do that. If you can't do that, if you can't pay P&I for whatever reason, we often recommend and even help our clients schedule paying interest only, because when they pay interest only, they flatten the liability. So when you flatten the liability and pay interest only, it works almost like simple interest. So whatever loan interest you have to pay, as long as you're paying that in a timely manner, it's not going to compound against you. Case in point, let's just say that this is a $10,000 loan at a 6% interest rate. A lot of people don't realize this, but what the carrier does is as soon as you borrow, and most carriers do this, I should say, what they're going to do is they're going to tack on that interest right here. So in the $10,000, they're going to tack on $600 and just call it your total loan balance. Now, what's nice is if you do pay down loan interest or you do pay down principal, then what they're going to do is they're going to credit you back some of that interest you paid, depending on exactly when you paid it, to your policy. So when you pay principal and interest, or you pay interest only, this can work like simple interest. And again, it's a recipe for success when you're only paying simple interest on a flat or decreasing balance, but you're earning compound interest on an increasing balance. Now, some people, for whatever reason, won't be able to even service interest only. So if you can't, we do recommend that when you can, that you pay these unscheduled payments during your lifetime. So let's just say you were investing in rental property and you had to make improvements, so you just couldn't afford to pay anything. Once those improvements were done and rents start coming back to you, then as you get some cash and you build up some comfort, we recommend starting to pay down that loan, even if you're just doing it kind of one-off and manually. Now, even if you can't, like let's just say you have a major project, you have some serious cash flow constraints. Again, it's a life insurance loan against the death benefit. Technically, as long as the compounding in your cash value is growing by more than the liability against you, you'll have a policy in force and the death benefit will pay it off. It's nice when you have performance, or at least if you continue to pay premiums in the policy, then this line will almost certainly beat this line. And we've run illustrations like that where it actually works out to be quite favorable for people when they do this. Again, with the 401k loan, you got one option: structured principal and interest payments. So hopefully this helps to dispel some of the myths about life insurance policy loan. Why would I want to borrow my own money? Why would I want to do that? What am I paying myself back? Hopefully you see that there are some clear advantages to utilizing life insurance as your own bank, and that life insurance loans aren't exactly like traditional consumer debt. And if you treat them responsibly, you can actually produce a better result for yourself and your family in the long run.